Welcome to SS2 Economics, Term 1, Week 1. This term we move from the macroeconomics focus of SS1, individual consumers, firms, and markets, to macroeconomics, the study of the economy as a whole. Macroeconomics deals with national income, employment, inflation, money supply, government policy, and international trade. The foundation of macroeconomics is national income accounting, the system for measuring a country's total economic output. Understanding national income enables policymakers, businesses, and citizens to assess how an economy is performing and what interventions may be needed. In Nigeria, the National Bureau of Statistics (NBS) measures national income quarterly and annually, and its reports influence government budgets, central bank policy, and investor decisions. National income is the total monetary value of all final goods and services produced in a country within a given period, usually 1 year. The key word is final. We count only goods sold to the final user, not intermediate goods used in production. If Dangote Flour Mills buys wheat from a farmer, the wheat is an intermediate good, it is not counted separately. Only the bread sold to a household is counted as a final good. This avoids double counting. National income can be measured in 3 equivalent ways: the output method, the income method, and the expenditure method. All 3 should give the same result, because every naira of output produced creates a naira of income for someone, and every naira of income is eventually spent on output. We call this the circular flow of income. In a simple 2-sector economy with only household and firms, income flows from firms to households as wages, rent, interest, and profit, and flows back from households to firms as spending on goods and services. Method 1, the output method. We add up the value added by every industry in the economy. Value added is the difference between the value of a firm's output and the value of its inputs. For example, if a furniture factory buys wood worth 100,000 naira and sells furniture worth 350,000 naira, its value added is 250,000 naira. Summing value added across all firms avoids double counting. In Nigeria, the NBS uses the output method, dividing the economy into sectors: agriculture, crop production, livestock, forestry, fishing, industry, oil and gas extraction, manufacturing, construction, utilities, and services, trade, transport, telecommunications, financial services, government services, education, health. Method 2, the income method. We add up all incomes earned in the production process: compensation of employees, wages and salaries, gross operating surplus, profits of firms, and mixed income, income of self-employed. Interest and rent are included. Transfer payments, pensions, social security, scholarships are not included because they are not payments for current production. Method 3, the expenditure method. National income equals consumption spending by households, C, plus investment spending by firms, I, plus government spending on goods and services, G, plus net exports, exports minus imports, X minus M. This gives the formula Y equals C plus I plus G plus X minus M. This is the aggregate expenditure model, which we will study in detail throughout this term. Several related concepts are essential to understand. Gross domestic product, GDP, is the total value of final goods and services produced within the geographical boundaries of a country in 1 year, regardless of who owns the resources. If a Nigerian company operates a factory in Ghana, the factory output is counted in Ghana's GDP, not Nigeria's. Gross national product, GNP, is the total value of final goods and services produced by the nationals, residents and citizens of a country, regardless of where production takes place. GNP equals GDP plus income received from abroad by Nigerian nationals minus income paid abroad to foreign nationals. Gross national income, GNI, is essentially the same as GNP and is now the preferred term used by the World Bank and NBS. Net national product, NNP, or net national income, NNI, equals GNP minus depreciation, the wear and tear of capital equipment during the year. National income at factor cost equals NNP at market prices minus indirect taxes plus subsidies. In Nigeria, economists distinguish GDP at current prices, measured using prices in the current year, and GDP at constant prices, measured using prices in a fixed base year. GDP at constant prices shows real growth, removing the effect of inflation. Nigeria rebursed its GDP in 2014, shifting the base year from 1990 to 2010, which more than doubled the measured GDP and made Nigeria briefly the largest economy in Africa. Per capita income is national income divided by the total population. It gives a rough measure of average living standards. Nigeria's GDP per capita in 2024 was approximately $1,500, much lower than South Africa, $6,000, and far below rich countries such as the United States, $80,000, or Norway, $100,000. However, national income statistics have important limitations. First, national income does not measure distribution. The high GDP may coexist with extreme inequality. In Nigeria, the top 1% of households holds a disproportionate share of national income. Second, subsistence production, food grown and consumed on the farm without market exchange, is difficult to measure and often underestimated. Nigeria has a large subsistence agricultural sector. Third, the informal economy, market stalls, domestic services, small-scale trading, and the large informal sector in Lagos, Kano, and Abuja, is largely uncounted. Fourth, national income does not measure welfare directly. Environmental damage, crime, long working hours, and poor health reduce welfare but are not subtracted from GDP. Fifth, international comparisons using GDP per capita are distorted by exchange rate fluctuations. The purchasing power parity (PPP) method adjusts for differences in the cost of living between countries, giving a more accurate picture of real living standards. To summarize, national income measures the total economic output of a country in a given period. The three methods, output, value added sum, income, wages plus profits plus rent, and expenditure, C plus I plus G plus net exports, all give the same result if measured correctly. Key concepts: GDP, production within borders; GNP or GNI, production by nationals; NNP, GNP minus depreciation; national income at factor cost, NNP minus indirect taxes plus subsidies; per capita income, NNI divided by population. GDP at constant prices measures real growth. Nigeria rebursed GDP in 2014. Limitations of national income: ignores distribution, misses subsistence and informal sectors, does not capture welfare directly. For WAEC, be able to define national income, state the three methods of measurement, define GDP and GNP, explain why GNP and GDP may differ, list limitations of national income as a welfare measure, and calculate simple national income from given component data.